0.6%. With us now, I'm pleased to say, TD's Priya Misra, Jim Bianco of Bianco Research. Priya, first to you, your first take on this one.
Sure. So I think there were some positives in the form of this. Inflation has clearly peaked. I think we're seeing goods inflation continuing to decline. What I'm a little surprised by the market reaction is that the service inflation, so service CPIs, shelter inflation, core services ex shelter, that's still high. It's actually accelerated over the last couple of months. I think if you take the Fed at face value, that's what they care about. I think the easy part of the decline in inflation may be underway. Goods inflation's declining, commodity prices are falling. The much harder part is getting that service inflation down consistent to 2%. I think the market thinks that, they can extrapolate this trend and that the Fed has maybe one or two more 25 basis point hikes. I think the Fed may have to actually continue to hike. So our call is 5.5 for that terminal rate. We're calling for a 50 in February. I mean, maybe that's a 25, but I think the Fed's going to say we're not done. I think the market's a little too optimistic, extrapolating that this decline in service inflation will continue. And historically, service inflation is very sticky on the way down.
Jim Bianco, are you on the other side of that argument?
Not really. I think that what the market should be focusing on as we go forward from here is where do we go next? Okay, inflation peaked, 9% was the high. That's the easy call. It's very obvious that that's happened. Are we going to 2% without any kind of intervention like a recession or anything else to dampen demand to get us down there? Or, as Mike McKee just pointed out, do we bottom out somewhere around 3 or 4%, the 3 and 6 month averages that we've seen? Is that where we bottom? Because if that's where we bottom, that will be unacceptable for the Fed, and that they will not be looking to pivot or they won't be looking to slow down the rate hikes. Yes, they'll move 25 basis points in February. That has been priced in for a month now, that it would be a 25 basis point move and maybe 25 basis points after that. But I think the narrative and the attention should turn to how far down are we going to go, not has inflation peaked.
This is what Sarah House of Wells Fargo is getting at as well. She says we're approaching this last mile, this big effort, and that last mile will be the hardest mile. Priya, you've made the same point. Just how much demand destruction do you still think we need to get inflation to where the Fed wants to see it?
So I think we need a lot more demand destruction, particularly in the labor market. I think businesses are hoarding labor. Wages did come down a little bit last week, but, you still look at year-over-year wages well north of 4.5%, not consistent with 2% inflation. I would also argue the lags point, the long and variable lags. The Fed is looking at data right now, and that data on the labor market does not suggest that demand destruction. How forward-looking can the Fed be to say that we think this demand destruction will happen in the labor market 6 months out? I think if you take them at face value, they are saying they're responding to data as it comes in. So, our view is they are going to be late. And I think the market is cheering. We're pricing in more rate cuts at the end of this year, more cuts next year. I think that is a mistake because the Fed is telling us they're worried about the mistake of the 70s. They really want to see that 2% inflation. And my views are there are structural forces that's going to keep inflation high until the Fed accepts that and is perhaps okay with a 3% inflation. They are going to be really reluctant to, I would even argue, stop hiking, let alone start to cut rates. So this optimism why the 2 years falling is all these cuts getting priced in. I think that can get taken out as we hear from the Fed that they can stop at, maybe it's 5.25 or 5.5, and then they're going to just stay there for a very long time while that demand destruction that you talked about is an intended consequence of policy, and they have to see that through. And I think the market's already looking ahead to when can that easing happen. I think we'll be waiting for quite some time for that.
Priya, you mentioned what's happening right now. Neil Dutter of Renmark is pushing back against all these recession calls and talking about what he thinks is happening right now. Financial conditions are now easing and have been for a couple of months, supporting economic growth right now. Instead of long and variable, I think the lags are short and predictable. Jim Bianco, your thoughts on that? The fact that some people think we're actually seeing a re-acceleration in the U.S. economy.
Yeah, there's plenty of evidence to suggest that initial claims this morning at 205,000 And there really isn't a lot of evidence that the economy is slowing. When Priya says, we need to see more demand destruction in labor, I want to say we need to see any demand destruction in labor right now, because 3.5% unemployment, 205,000 in initial claims, and still printing 200,000+ for payrolls every month, that's not demand destruction at all. And if those numbers continue to move forward from here, it's going to be hard to bring that wage inflation down, which is at 4.5%, I think much below 3.5% or 3%. And according to Powell's, services ex housing, you're not going to see inflation, dip into a 2 handle without that demand destruction. And if we don't get it, then we're going to have to pivot that narrative, as I was talking about earlier, to not just that inflation is peaked, but how do we get to 2% without a recession? And if we come out of a recession, does inflation just bounce right back up above 2%? And that's an uncomfortable question for Wall Street right now.
Mike McKee mentioned Patrick Harker a few minutes ago, leaning towards a 25 basis point hike over at the Philly Fed. He says this, though, in response to some questions in the Q&A, favors rising rates a bit above 5% and then pausing. Now, to your point, Priya, if we take the Fed at face value, they're not cutting interest rates. But I think the problem at the moment, Priya, is that I can't find many people that are taking the Fed at face value. Can you?
I think that when you listen to the Fed, all they can sort of tell us is the reaction function. So maybe the markets understood their reaction function. I think where the debate in the market is the economic outlook. I think the market is a lot more optimistic than the Fed in terms of how quickly that inflation will decline. Look at the TIPS market. Market's pricing in 1-year inflation at 2%. I mean, we're talking about will it settle at 3%, as a good thing. But the market's pricing in well below that. So I think the market pricing in these cuts is not so much second guessing the Fed reaction function. It's saying that the economy might be much weaker, that inflation might be much weaker, and so the Fed will have the ability to cut rates because inflation is back down. I think the uncomfortable question, to Jim's point, is what if inflation does settle at 3%? Then I think the Fed is telling us very clearly that they need a much higher rise in the unemployment rate, closer to, I would say, 5%, which we're very far from, before they can respond. So it's really this tension of what is the economic outlook? The Fed has one view, and I think the market is saying, oh no, inflation's now headed down, just as we couldn't quite forecast how quickly it would rise. I think the market's saying, we've all gotten it wrong, inflation's going to decline much faster. And I think that might be the disconnect, why the market is so much below the Fed dots.
Well, there's another dynamic we need to discuss as well. And Jim Bianco, that's China reopening. How much does that complicate the outlook?
Oh, I think it complicates the outlook a lot, because while China is reopening, zero COVID is gone, the mobility numbers are showing, like the transit numbers, that people are getting out of their house and finally moving around. What does that mean? Wall Street wants to think that means, 2019 is coming back. Everybody's going to return to the factory and we're going to make iPhones just like nothing happened in the last 2 years. Or does it mean in China, like it's meant in the West, that while we got out of the house and we started moving around, there were fundamental changes to the economy in the West, work from home, remote work being the biggest one that we're all familiar with. Does China experience some kind of a fundamental change so that just penciling in a return to 2019 growth rates and 2019 production rates because zero COVID has been lifted might be a little bit premature? Yeah, they're going to reopen, but we don't know what the composition of that's going to look like, and that does complicate things.
Have you got a base case yet, Jim, or is it still too early?
I think it's still too early, but if I had a base case, it would probably be that the production numbers that everybody's expecting, really what Wall Street is expecting is raw material prices are going to rise because China, the factory of the world, is going to suck everything in, whether it's industrial metals to energy, push up those prices. Out the backside is going to be a bunch of finished goods, which is going to help to further depress core inflation. That's been the narrative for the last few months. I think that probably the first half is going to unfold, but the second half, as far as the massive amount of finished goods, because if China's listening to everybody else, where the world's going into a recession, they're not going to be ready to really crank up production as hard as we think or hope that they are, that might disappoint a little bit as we move forward.
Priya, just a final word on China, please.
So one of the things I'm watching is on the stimulus front. I mean, if China has opened up, how much are policymakers there going to put in terms of fiscal stimulus, credit easing? Remember 2015, massive amounts of credit easing, then was a global growth positive. Our view is it's going to be more targeted. It's going to be more domestic leaning as opposed to a global growth surge. But I'm certainly watching those credit numbers. And if that starts to ramp up, I think it takes a big tail risk for the economy out. And that can explain why, we're talking about a recession and yet financial conditions are easing. Well, because China is going to be this growth engine due to easing. I think it's still early. We're watching both fiscal as well as credit easing measures in China to see what the global growth outlook, what China growth outlook will be beyond just what's happening in the U.S., which I think a slowdown is at this point in our view, we have a recession baked in for the second half of this year.
Priya, Misra, Jim Bianco sticking with us. Equity futures right now fading just a little bit, still positive by 0.2% into the bond market, where we have got this rally at the front end of the curve, rally right the way through the curve, but particularly on the 2-year. We're down about 7 basis points on the 2-year to about 4.15 in the FX market. Some dollar weakness for you. Euro dollar just in and around 1.08. Coming up, another cooler inflation print for DC.
We got an inflation report exactly as we expected. We also got a reminder that the labor market is running pretty hot.
The View from Washington up next.
Yes, we got an inflation report exactly as we expected. We also got a reminder that the labor market is running pretty hot. Aggregate demand has momentum. That's putting pressure on resources. That will put pressure on wages and therefore on prices. Maybe not this month on prices or wages, but the mechanics are there. The mechanism that you worry about inertial inflation is there.
A little bit of good news for the Biden administration as the nation sees 3 straight months of cooling inflation. The president preparing to deliver remarks at the top of the hour. This coming as the controversy over classified documents continues to unfold in Washington. Bloomberg's Anne-Marie joins us now from the White House. Morning, AMH.
Good morning, John. That's right. The president is likely going to seize on these numbers, especially the month-on-month decline. And so much of that was driven by the drop of gasoline prices, when just a few months ago, this was the biggest political headache facing this administration, especially heading into those midterm elections. And now they can really breathe a sigh of relief of where gasoline prices are going. But we should note he cannot claim victory too quickly. One, on gasoline prices, because whether it's Pierre Onderon or Will Kennedy in the last hour with you and Tom talking about oil prices, they are expected to go up. So potentially it's too quick to really claim that victory on where gasoline prices are going in the future. And there's also other factors in this CPI report, like shelter, like recreation, like clothing, that is going up. But overall, this is a good sign for this administration.
Can you tell me what the plan is to refill the SPR, Anne-Marie, and how much the China reopening complicates that effort?
Well, now that you see prices much higher, Jonathan, it's going to be incredibly difficult for the administration to refill the SPR. They want it really below $70 a barrel, and we are already above that. And when you have Pierre Onderon, when you have Jeff Curry talking about prices north of $100, that is not going to mean a refill of the SPR anytime soon. And China obviously is the biggest question mark on this in terms of how higher oil prices will go, and then thus gasoline prices. Because if we have a quick and clean reopening of China and they start consuming a lot more, and you can see the trend of just automobiles on the streets in Beijing and Shanghai start ticking up higher, then that's going to mean higher oil prices and less of a fact that the U.S. is likely going to want to refill that SPR anytime soon.
AMH, thank you. Down at the White House, we'll hear from the President of the United States in about 40 minutes' time, scheduled to speak at 10 a.m. Eastern Time. Priya, Misra, Jim Bianco back with us. Jim, I want to talk to you about the fact that we came into this year waiting for this growth slowdown, and all of a sudden people are starting to pile in to long EM equities, long European banks over the last 6 months. The copper trade starting to deliver in a massive way. 9K, Goldman talking up 11.5 maybe at some point this year. Looking at high yield spreads on the screen right now. The wides of last summer were 583. We're at 420. Credit spreads are rallying. Jim Bianco, make sense of that as we discuss the possibility. Priya's talking about the potential of a recession in the second half.
Well, let's start with the most powerful drug on Wall Street, and that's mean reversion. That when you show a bunch of professional managers markets that are down a lot, their instinct is to bet that they are going to rebound to revert to some kind of a mean. So a lot of what you're seeing, as you mentioned, just to pick one, European banks, European bank stock index is at the same level it was in 1987. There has been no movement in European banks for 35 years. So the 40% rally that we've seen in them since July is more, I think, in the mean reversion camp. So there's a lot of that going on in the market, too. Second of all, the narrative on Wall Street has always been a weak first half, strong second half. So to take a word from the recent past, everybody thinks that the weakness is going to be transitory and that it will give way to a second half strength. So look past whatever weakness we see, look past whatever potential recession talk that we've seen, because don't worry, by the third or fourth quarter, we'll be past that. And stocks and supposedly risk markets, as you mentioned, are supposed to be more forward-looking than that.
The consensus is starting to crack pretty quickly. It's only January 12th. We'll see how this shapes up in about a week from now. Priya, just a final word from you on this. This headline across the Bloomberg a few hours ago that you've responded to already, but I'd love your input on. 3-month Libor. Dollar Libor exceeding the 2008 financial crisis high. Priya, I guess my first question to you is just how relevant is that anymore?
It's not relevant. I mean, there are very few new contracts actually do not take Libor. The existing contracts, Libor is going away in now less than 6 months. They're all going to move to SOFR. So I would say it doesn't matter. What it does show is bank funding costs are going up. I mean, the banks are having to pay more to keep deposits. They've been losing a lot of deposits as Fed fund rates have been rising. You know, are banks raising money in the wholesale market? I think the general trend, why it moved today, I think is not obvious. But, you know, there's a process how that Libor is computed. It's still a floating rate index. It's going to go away. So I think it doesn't matter. But it does reflect that bank funding costs are going up. NIMs are under pressure. If the Fed keeps hiking, I think you'll continue to see these funding costs for banks continue to rise. I think that's what it's reflecting. But it shouldn't be a worry for anyone, because that index itself is going away.
Tomorrow morning, JP Morgan, BofA will be focused on that. Priya, thank you. Priya Misra there and Jim Bianco. Priya with some big calls looking for